Welcome to this video on operating profitability and working capital analysis, with actually an emphasis on that first part, operating profitability. And to be more specific, we will be mainly focusing on operating costs. This is where the focus of the curriculum is, at least in this section of the relevant reading, operating costs. Okay, if this is your first encounter with the Let Me Explain YouTube channel, then I hope you like the video and you choose to subscribe to the channel. And you may also, which I encourage, decide to be a supporting member by joining the channel, and then you get access to all the video resources, that growing database of video resources which are posted to the channel on an ongoing basis. Right, operating costs, what are they? Well, there's something you'll find in the financial statements, and we'll be looking at financial statements in just a moment, but the definition is these are costs incurred, so costs suffered by a business in in association with generating current period revenue. So we typically think of these as being the costs of either acquisition, or indeed the cost of production of goods. Those goods which the customers buy during the relevant period. The company acquired at some cost, maybe produced at some cost, and that is obviously the cost of goods sold, or the cost of sales. Right, goods, but also services. And there's also a cost, associated with the act of selling. Maybe you operate a shop, a sales outlet via which you sell. Or there are distribution costs which are borne by the company. Those are also selling costs. On top of that, operating costs will also include things like the management of business activities, which we often associate with certain admin costs. There's also compliance, or the costs of compliance with laws and regulations, legal costs, for example, during the period. And all of these, are or fit under the heading operating costs. Now, there are various ways to categorize and classify these operating costs, and your book does devote a fair amount of space to this categorization of operating costs. The first, let's say, split, or the way to categorize, is very intuitive, i.e. variable costs, and those are the ones that vary with output, with the amount being produced, sold, and of course fixed costs, which are the ones that do not vary quite naturally. And I will be saying a little bit more about that in just a moment. Then there is the split by function, which you'll typically find when you look at financial statements, because in the financial statements, operating costs are indeed most typically split on a by function basis, where a function means the purpose of the cost. So, I'll show you an example in a moment. The split will typically be, there are many different ways to do this, but cost of goods sold, COGS, being one at the top. Then you've got very often sales and marketing, or sales and distribution, something like this, stroke marketing. You'll typically have admin costs, or general expenses, different names, but the thing is, this is by function. So, for example, both sales and admin costs would include employee benefits, the cost of salaries, wages and salaries of people working in different functions within a company. So let me now show you an actual example of this. What I've got on my screen is the consolidated sort of profit or loss statement for one of Poland's biggest companies, a company called Orlen. They are a huge sort of energy business. They're in the oil business, but also natural gas. And you can see this is their income statement, starting with sales revenue. All of this is in, I guess, in millions of the Polish currency, in millions of zlotys. So, 6 additional zeros need to follow. But look at this. We've got costs grouped into cost of sales. Cost of sales is the cost at which the business acquired raw materials, but also produced whatever went to the customers as part of sales. So these are matched in terms of the matching concept. And then, more critically for what I want to show you now, is we've got under gross profit, we've got distribution expenses, administrative expenses, and some other things. Now, this is your classic functional presentation of costs, because as I mentioned before, distribution expenses and admin expenses will contain things like employee benefits. Both of those categories will. But the employee benefits associated with employees working in the respective function. For example, administrative expenses will include the cost of departments like, or functions like HR, or the legal department, or the finance team within this company, or the IT team. So everybody who's kind of supporting the business. Distribution expenses will cover the cost of running the fuel station, which this company has a lot of in Poland, but also, for example, in the Czech Republic. Those will also be those distribution costs, the cost of marketing, the cost of logistics, transporting the fuel across different geographies to the actual petrol stations, right? And so this is a split by function. Just as equally, we could have another split, which one can sometimes find in the financial statements, but typically the income statement, or at least the face of the income statement for most companies, will be done on this by function approach. But there's also a categorization by nature. And nature means what the cost actually is. And then you would classify these costs by type. So employee benefits, for example, employee costs, or maybe the cost of raw materials, or maybe things like energy used, electricity used, or depreciation. That's another operating cost, very specific one. And look, even though this company on the face of the income statement presents this categorization, if we go to the relevant note, this note 13.10, right, which is somewhere further on in these statements, let me try and find it. Right, it's a huge financial statements because of the fact that the company is quite complex. Quite close. Okay, this is a note concerning the costs. Good. Cost of sales. And then look at this. They've got a split of the costs by nature. So here they'll show us what the costs actually are when we call them their real name, like employee benefits, depreciation, cost of external third-party services, merchandise, raw materials, materials and energy, that kind of thing. So sometimes within the financial statements you'll find the two splits, one presented on the face of the income statement, like you saw here, the by function presentation, and then in the notes you may have some more details concerning the by nature split of these costs. Right. Now, let me tell you now about the split into fixed versus variable costs, because your curriculum, for some reason, tries to introduce a few formulas that to be honest, in the past used to belong in the corporate issuers segment of the curriculum, and now, without too much explanation, they're just throwing it in over here within equity investments. Well, fine. Hopefully they will be quite easy, quite intuitive. First of all, operating profit. Operating profit can be expressed as, let me open a bracket over here, a square bracket, Q, which is the quantity, or, well, not the quantity, the number of units, so quantity, but number of units, sold, right, so Q, multiplied by P minus VC, where these two are respectively the price and the variable cost, but on a per unit basis. So the term in that bracket over here, P minus VC, well, it's called contribution margin, and that's a good thing to remember, that this is the contribution margin. It's the difference between the selling price of a unit and the variable cost to produce it. And when we multiply by quantity, we obviously get that on a per company or at the company level. But why is it called the contribution margin? Well, when I took your book doesn't explain this, by the way, but when I took my accountancy exams, which was even before my CFA exams, the explanation of this was, well, that difference is what contributes to the coverage of fixed costs. So operating profit also has to contain an adjustment or include an adjustment for fixed operating costs. And these are not expressed on a per unit basis. They're sort of block lump sum, fixed operating costs. And the idea is that what's in the square bracket should be higher than fixed operating costs if the company is obviously to generate some operating profit. Now, additionally to this idea of operating profit, we also have the concept of operating leverage, which, once again, in the past, this used to be a big thing in the exam. Nowadays, it seems to be very sort of constrained to a few sentences. Okay, fine. This is the amount of fixed costs that are present in the operating structure or operating cost structure of a business. When you run a business, you can make a conscious decision sometimes about to what extent do you want to rely on variable costs, for example, hired employees on a temporary basis via some agency, versus fixed contract employees that are with you, rented out facilities versus your own. And the more you decide to have on a fixed basis, the more operating leverage we'll have. And that will also impact the so-called degree of operating leverage, DOL. This is a measure which takes into it, it's basically a fraction, right? So it's something divided by something. It's the percentage change. Now, in your book, when they want to talk about change, they often use the triangle symbol, which is delta, right? This is delta, which stands for change, also in mathematics, in physics, right? The percentage change in operating profit for some percentage change in terms of sales. So when sales go up, sales revenue goes up, or to be honest, this is about quantity sold. When the quantity sold goes up, let's say by 1%, what's going to be the reaction in operating profit? And the strength of that reaction, that sensitivity or degree of operating leverage, will depend on the degree to which you are relying on fixed costs versus variable costs. When things are going well and you can increase your sales without increasing costs because a lot of your costs are fixed, that change over here in the numerator will be higher. On the other hand, when your sales are dropping and you've got a lot of fixed costs that do not drop as well with the volume of output, then the change in operating profit will be once again magnified. So having operating leverage is a double-edged sword. In good times it works really well because it allows you to magnify your gains, but it also magnifies your losses. And it's the same concept. Leverage is a very sort of universal concept. It works well when things are going well. It doesn't work very well when things are bad. Now, the book does have a few numerical examples on this, but in the end of chapter problems, it seems to be sort of much more discursive, much more theoretical. Let me just go back one moment for this categorization by function and by nature. Both IFRS and US GAAP say that the face of the income statement, typically that first page within the financial statements, first page could be a balance sheet or the income statement, can be done using one or the other approach, require one or other presentation approach, presentation format, one of these two. But most companies choose, like I've already said, most companies, however, choose the functional method or the functional approach, that top one, which means a lot of financial statements look absolutely very similar. I've already shown you one company from my home country, Poland, Orlen. Let me now show you a different one. This is, ladies and gentlemen, the financial statements. You may see this at the top here. Inditex Group annual report. Inditex is a huge clothing apparel company from Spain. They're the owner of some very famous clothing brands, including something called Zara, which may be popular where you come from or not. That depends on where you are. Look at this, another example of functional presentation with costs being aggregated into categories like cost of sales and then just operating expenses. They don't even make the split into admin, selling and distribution costs, just operating expenses. But look, one very interesting thing that they've done is they've also taken the care to present amortization and depreciation separately from other operating expenses, because most companies would just include the amortization and depreciation within operating expenses. They've done something different. They've presented that cost line separately, so without having to go into the notes, we have a clear presentation of gross profit being the difference between net sales and cost of sales. That's what you'll always find in an income statement. But then EBITDA, so earnings before interest, taxes, depreciation and amortization, then depreciation and amortization is presented as a cost, and we end up with net operating profit, or operating profits, our EBIT, before obviously financial costs, or financial income and costs, which are a net expense here, and income taxes. Okay, proof that indeed functional presentation seems to be very much in vogue pretty much all over the world. Now, I want to finish off with just 3 additional small comments. The curriculum mentions economies of scale. When an analyst is looking at a company's operating profitability, well, economies of scale are going to be a pretty important concept. This is, of course, the phenomenon of declining or a decline in the cost per unit as output increases. And that's, obviously we're talking about primarily operating costs on a per unit basis, and that's because whatever fixed costs we've got in the business, those get spread over more units of output. Yeah, absolutely. But then there is another term which is actually quite, related. It's economies of scope. And that means, once again, a decline in cost per unit at the company level, but not as the output increases, but as the number of products or business lines goes up. Now, with the number of products and business lines going up, we typically, also have an increase in output, but this is not output of the same thing. And this results from simply shared costs between business lines. We don't have to have 4 or 5 compliance functions, legal departments, finance teams, etc. We can share certain especially central costs. Related, however, I think both concepts are very much related, and sometimes it's not easy to tell them apart. Now, I want to finish off with a few words about working capital. It was one of the items listed or mentioned in the top of the video. We said over here operating profitability and working capital analysis, but to be honest, your book is very vague here. They just talk about pretty much activity ratios without even giving you the formulas for the activity ratios. They kind of go, there are these activity ratios like days of sales outstanding, or days of inventory on hand, days payables outstanding, and the expectation is you'll know these ratios because you've already studied corporate issuers. So if you go to my videos on corporate issuers, there is a host of videos which talk about activity ratios and what they depend on, how to calculate them, and of course always that critical thing called the cash conversion cycle. And when you look at the numerical examples for this, the expectation is you will appreciate what these things are and how they combine into the cash conversion cycle. And because I've done plenty of videos on it on the channel, I'm not going to talk about it here, but make sure to watch those working capital management videos within corporate issuers.